Good afternoon. I'm Kavisha Vilatkamua. Hope you all can hear me. On behalf of the Institute of Chartered Accountants of Sri Lanka, I would like to welcome you all to the webinar on Investment Strategies for Individuals and SMEs, a webinar organized by CA Sri Lanka CPD unit. This session will focus on importance of investing, tips to identify own investment strategy, benefits of diversification, available investment opportunities in Sri Lanka. Our speaker for this evening is Mr. Deshan Pushparaja. Mr. Deshan Pushparaja is the Managing Director, Global Markets and Investment Banking at Cal Finance. In addition to possessing a bachelor's degree in applied accounting from Oxford Brookes University, UK, Mr. Pushparaja is also a CFA charter holder and a fellow of the Chartered Institute of Management Accountants, plus the Association of Chartered Certified Accountants. He is an internationally recognized expert in public and private capital markets. He has developed a high profile network of clients in local as well as global capital markets on the basis of superior standards. With the group since 2007, he has led the CAL team through Sri Lanka's post-conflict economic landscape towards market leadership in equity capital markets and a strong position in debt capital markets as well. We have allocated the time towards the end for the questions of the audience. Please type your questions on the Q&A sections as well as chat option for the convenience of the speaker. So, without a further delay, I would like to invite Mr. Deshan Pushparaja to take over. Over to you, sir.
Thank you, Kavisha, and thank you for the introduction, and good afternoon to all of you. So what I'm going to do is I'm going to share some of my thoughts on this particular subject that Kavisha wanted me to speak on, which is investment strategies for individuals and SMEs. And I'll take about half an hour to 35 minutes or so, and I'll take you through the presentation. And I'm happy to answer any questions at the end. I know a lot of you have questions regarding the various investment opportunities available for you, and I'm happy to answer some of those questions. And wherever possible, I'll try to provide some anecdotes on some of the investment opportunities available and how and how you may be able to participate in those as well. So I hope everybody can see my screen. Let me jump right in. So the trick in investing, and this is where I think many individuals, especially in Sri Lanka, do fall short when you think about investing, is is your money working for you? This is a very important question, because a lot of people that I've met, and I'm sure a lot of you as well, work really hard to earn your money. Whether it be an SME, a small business, where you are working hard, taking significant risks in order to earn the funds that you have, earn the capital that you have, or as an individual, if you've been working in a company, earning your salaries, earning your bonuses, and making significant sacrifices to save your money. What happens is, once the money is earned, and until this point that the money is earned, you're very strategic about it, you work really hard, and once the money is earned, more often than not, this money is kept in a bank deposit. Because once the money is earned, you want to keep it safe. But that's where therein actually is the difference between saving and investing. Because once a lot of individuals and a lot of SMEs, once the money is earned, the primary focus of that money is to save it. And this is where, as I said earlier, many people don't take a strategic approach to investing, because everyone is concerned about primarily making sure that the money that they earned is safe with them. Now, the problem with that is that as long as you are not making your money work for you, you will you will continue to have to work till you die, because your wealth depends on you actually working. And this is what I would like to speak about, because this is an area I think if you have an understanding in, you could make sure that over time you can make your money work for you while you relax. And this is borne out in a very simple example here that I've shown you in this graph, where if an investor sets aside 5,000 a year for 10 years in a row, from 25 to 35 years old, this person will have roughly 800,000 by the time he or she is 65. But if you delay your saving by 10 years and you start saving only at 35 and you start investing this money from 35 all the way up to 65, you'll still be lower than the person who saved 5,000 a year only for 10 years. And that is because when you save early and when you start making investments early, that money starts working for you. And so you have to work less in order to earn the same amount of money. And anecdotally, if you had invested $1, if you had invested $1 500 years ago at an interest rate of 5%, today you would be worth 40 billion. And this concept is concept called compounding, because when you make an investment, that money, when you earn interest the first year, then you start, that money gets reinvested the second year, and that cumulative amount gets invested the third year. The compounding effect is huge. So a dollar 500 years ago is worth $40 billion today. So if your great 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 grandparents had saved 200 rupees, today the 200 rupees would be worth half of Sri Lanka. That's how powerful compounding is. And that's how powerful making your money work for you is. And so the question I want to start off with by asking you is, are you making your money work for you? Are you just saving your money once your hard-earned money? Is it just saved and kept aside? Or are you making your money work for you? And that's the fundamental question you need to ask yourself when you think about investing. So when you think about investing, there are many different options available for you, and I'll come to that in a bit. But the question is, should you have a plan? Should you have an approach to investing? And my answer is yes. Because if you don't have a structure, if you don't have a strategy around how you make your personal investments, then what happens is when you don't have a plan, you run after the newest fad. Uh, you know, some person is talking about, oh, land prices are going up, so you go and buy some land. Some person says that, oh, gold is going up, so you buy some gold. Today everyone's talking about the stock market, so you go and buy some shares. And now the new fad in some of the overseas markets is cryptocurrency and all of these things. So everybody's running after the newest fad. You don't have a plan, you don't have a structure, and so you don't know what you are doing. So it's important to have a strategy so that you can plan your investments. And not only that, but you can also define your goals. What do you want out of your money? Do you want to, buy a house in 10 years? Is it for your retirement? Is it, so that you can pass it on to your children? What is it that you are saving for? What is it that you're building for? I think it's important to write that down. And then also, in the meantime, also write down what are your other requirements. Do you have other expenses that you want to incur? Do you need emergency liquidity if somebody falls sick, that you can be able to draw on that? So all of these things you should write down and have a plan. The second is, if you have a plan around your investment, then you can also manage your risk. And this is fundamentally important when you think about your investment, because every investment has a risk. Every asset has a risk. Even land, although a lot of people talk about land prices never coming down, the reality is that it's not true. And we've seen that globally, when there are serious economic crises, land prices have come down 20-30%. So every investment does contain a risk. And so when you take a very strategic approach to risk management, you can manage this risk. So the answer to risk is not putting all your money in a bank deposit. which is what a lot of people do, because they believe that bank deposits don't have risk, and B, they don't want to take any other risks. But the reality is, the more risk you take, the more risk you can potentially earn. So if you manage your risk, then you can earn a higher return while taking very little risk. So again, this is important. And third is that you can start appreciating and actually enjoying the benefit of diversifying your investment. Instead of putting all your eggs in one basket, you start diversifying your investment. You start getting a much bigger benefit out of your investments. And number three is, you should have an investment strategy, because you should build your understanding of what is out there for you. What are the options available, because a lot of people don't know all the options that are available, and because of that, you know, they are limited in the things that they invest in. So when you have an investment strategy, when you write it down, here's what I want, here's my plan, here's my goals, here's how I'm going to go about it, here are the risks that I'm willing to take, and here are the assets that are available for me, then you can start actually making your money work for you. So this is a very important first step. So when you think about defining your investment strategy and philosophy, I just wrote down a few questions that you can ask yourself, and I'd encourage you to think about it and write down your answers to these questions, because this will define how you go about your investments. Number one, what are my core investment beliefs? This is not what am I going to do with my money, but what is it that I want my money to achieve? So very simply, you can say, I want a very high return. That's what I want for my money. So, or you could say longevity. That is, I want, it's not about the return, but I do want to make sure that I have sufficient money that I can pass on to my children. Or you can say, I want my money to go towards certain causes that will make a difference in the world. And this again is a new theme that's especially emerging in a lot of international markets, is that the new generation of investors want to make sure that their money is going towards a good cause. They are not doing charity, they are investing, they are hoping for a return, but they want to make sure that in doing so, they also make a social impact, whether it is, pulling people out of poverty, or making sure that countries are moving towards renewable energy, or reducing wastage. All of these things are also important objectives some investors have, that they want their money to go towards causes which make a change in the world. So if you write it all down, you'll know exactly what kind of, what are your investment beliefs. What are my number two is, what are my investment goals? Am I saving for retirement? Am I saving for my children? Am I saving so that after I retire, I can have a good time? Or do I want to retire early? Do I want to buy a house? What are your investment goals? Write it down. That's important. Then number three, it's a very personal thing. As a personality, how much risk am I willing to take? Are you some investors, some individuals are higher risk, they have a higher risk appetite than others. And so you can actually think about, what is your risk appetite? Are you willing to take a higher risk? The higher risk does sometimes mean higher return, but also you can also lose money. Whereas lower risk means lower return, but at the same time, the risk of losing money is low. And that's personal. You can think about it and write it down. And next one is there anything I will not invest in? And each of you have, your personal constraints. Some don't want to invest in interest-bearing assets because of religious reasons. Some have restrictions around what I could call sin companies, or companies which are involved in tobacco, alcohol, gambling, all of that. So it's personal again, but write it down. What are the things that I don't want to invest in? Then number five is, how much time can I commit to my investments? Because this is also important. Do you have the time, given that you also have a job or whatever it is that you are involved in? Do you have the time to sit and think about all your investments all the time? And some people do, but others may not. But it's important to think about it and write it down. How much time do I have to commit to looking at my investments? Because the more time you commit, the more you are able to commit, the more specific your investment strategies can be, and your money can work for you harder. What asset classes are available for me to invest in? Do I understand what are the assets that are available? What are the opportunities that are available for me, and what are the risks? Do I understand them? Then can I make any commitments to set aside further ongoing earnings each month or year? So can I commit saying that I'm going to start saving X amount, 10,000 or 20,000 or 100,000 rupees a month going forward all the time? Or maybe once a year, I make a commitment saying I'm going to invest X amount once a year. Can you make any commitments? Again, it's your choice. You write it down. Then, do I have any ongoing income requirements? Am I depending on this investment to make a living, or am I building on this investment for the future? And both are, again, if you are a retiree, for instance, and you need to depend on the income that is generated from your investment for you to make a living, write it down. If you say, no, I don't need this income today, this my money can stay for the next 10, 15 years, and I'll need it probably sometime in the future, write it down. So these are the broad 8 questions that I feel you should ask yourself and write down the answers for, so that you are clear in your mind as to what your investment philosophy and thinking is. Once you have this, and some before that, a few tips that I want to kind of share with you um, when you think about your investment strategy. Number one, when you grow older, your risk appetite does reduce, both as a personality, because when you're young, you have less to lose, and so you're willing to take a higher risk. When you're older and you have responsibilities and you have more money to lose, and bigger opportunity costs, your risk appetite does start reducing. But also, when you are young, if you even if you make a big loss, you can always recover it. But when you're older, if you make a big loss, that can completely derail your life. I've seen retirees who invested their money in fixed deposits or failed finance companies, who now have no money to live. And so, yes, as your age progresses, you do start reducing your risk appetite, and it's probably for the best that you do. Number two, shorter your goal time frame, the lower the risk you should take. Now, I've seen a lot of people make this mistake of taking very high risks when you need some money in 3 months or 2 months for some particular requirement. You know, put it into the stock market because you think that you can double your money in that particular 2 months, and then you end up losing money. So, if you have a short time frame, don't take high risk, because the ability for you to recover your loss is very low. Personally, when I was young, I had some money available for me to do my exams, and um, I had one more month to pay for my exams, and so I thought I'll put that into the stock market because the stock market was doing well. I did that, and I ended up losing about 40% of my money. And by the time I had to pay for my exam, I didn't have the money. And I learned this the hard way, and then I had to borrow from somebody to pay for my exams. So I learned this the hard way. When the time frame is short, don't take high risk. If you have multiple goals, define all of them, write it all down so that you may have different strategies for different reasons. If you have some money that that you are putting aside because you want to make a particular expense in 1 year's time, your strategy for that would be different from a certain amount of money which you have decided to put away for your children. So write it all down because your strategy would be different for each one. Don't worry about knowledge gaps, because knowledge can always be gained. In this day and age, with all the information available and the people and the technology available, you can always fill your knowledge gap. So don't worry about the fact that you don't know about something, but define your overall philosophy first. And last one is very important is for SMEs. Make sure that you separate out what funds you need for the business and what funds are available for investment. I've seen many companies make this mistake that they use company money, the money that they use for working capital or for other particular requirements, they take that money and go and invest it in the stock market. They have invested it in land. They've invested it in apartments. I've seen all of this happen. And then what happens is when the business needs the money, your money is illiquid because you can't take your money out of whatever investment you have made. So it's very important, very essential that when you define the amount of money that you want to invest, that this money is money that you are 100% sure is not required for the business. Or if it is required for the business, then the type of money, the type of investments that you make should be liquid investments, which where you can pull out at any time. So again, write that down. So when you think about diversification, I think the principle of investing, one of the principles of investing is you try to make the highest return with the lowest risk. And this can be achieved by diversifying your investments. As I said, when you plan out your overall investment strategy and when you can diversify, then you reduce your risk significantly. So the reasons why you should diversify or have a portfolio of different investments is that number one, it minimizes the risk of loss to your overall portfolio. Because let's say you have 10% or 20% of your money in the stock market. And if the stock market comes down by 5%, if you have 20% of your money in the stock market and your stock market comes down by 5%, your overall portfolio is only lost 1%. So it minimizes the risk of loss to your overall portfolio. Number two, it exposes you to more opportunities for return. If you have property, if you have the stock market, if you have various different assets in your portfolio, then if one of those goes up, then you make money. But if you only have money in a fixed deposit, then you lose out on the return that you could have got from the stock market or from gold or from any other asset. So it exposes you to more opportunities for return. Then it safeguards you against adverse market cycles because every type of asset class goes through its ups and downs. And sometimes they move in opposite direction. So sometimes when interest rates are low and the economy is not doing well, the share market is not doing well, and sometimes commodity prices do well, gold prices do well. So it safeguards you against market cycles because you own investments which perform differently depending on the type of economy we are in. And number four is it reduces volatility because you have many different assets. So even if one asset price moves, it doesn't make a huge difference. So the principles of diversification, how should you diversify? How should you find any, different types of investments to put your money into? Number one is uh, find assets whose value does not move in tandem with each other. So try to find assets where if one comes down, the other goes up and vice versa, so that you can balance your risk that way. Number two is try to earn some ongoing income as well. Don't invest all into an asset which is only going to give you a return in 10 years' time. Because if that asset doesn't give you a return in 10 years' time, you wasted that entire 10 years. Whereas if you balance it with some, okay, I am investing some money for something that I'm not going to get a return back until 10 years' time. And then another portion of my money I'm going to earn so that every month I get some sort of return. Then you balance and reduce your risk. Then, while all assets can be included, the relative weights can reflect your risk appetite. So if you have a higher risk appetite, then you can own certain types of assets which are seem to be higher risk but can also give you a higher return. Whereas if your risk appetite is low, then you should still continue to have, for instance, exposure to the stock market. But if you are high risk, if you have high risk appetite, you can, let's say, have 30-40% or 50%. While if you have low risk appetite, you can have 10%. It's important to have all of it, but you can decide on the weight in your portfolio depending on your risk appetite. So I've just shown here again, this is a US example, but I want to show you how, when you make up a portfolio of various different assets and depending on your risk appetite, here's the kind of returns that, investors would have made in the last, 20 years. So in the last 20 years, the conservative portfolio has made a 3% return. Conservative portfolio has made a 6% return, and the most aggressive growth portfolio has made a 10% return, 9.7% return. So yeah, higher risk, higher return, and at the same time, uh, you know, the composition of each portfolio is different. Where you have the aggressive growth portfolio has a higher composition of shares in each portfolio. So this is just an example to show you that you could have different percentages of your money in different assets depending on your risk, and depending on that, your return also changes. So then we come to the question, what are the investment assets available in Sri Lanka? And not everybody is aware of all the options available. So I'm going to classify this into buckets. The first bucket is fixed income. So fixed income is where anything that promises you a fixed return on your investment is fixed income. And these could be classified as government securities, which are technically risk-free. Then you have debentures, which are issued by companies, a debt instrument issued by companies. Then, of course, you have the fixed deposits of banks and fixed deposits of NBFIs or finance companies. So these all give you a fixed and predefined return. But the risk that you carry in fixed income is, number one, is interest rate risk. What I mean by interest rate risk is, today, if interest rates are on their move up, on their way up, and today, if you put a fixed deposit at 7% or 8%, in 6 months' time, if interest rates are at 12%, you haven't lost your capital. Your capital is safe, but you have a big opportunity cost, because you have placed a fixed deposit at 8% when the market interest rate is at 12%. So that is called interest rate risk. The other type of risk is credit risk. That is, if I put money in a bank or a finance company or a debenture, that the bank or the finance company will default. Where this word default is now commonly used because of more in relation to sovereign bonds. But banks or finance companies or any other company may default or may not pay you back, and so you do carry some credit risk. So these are the two big risks that you carry when you invest in fixed income. Then the second type of asset that you can invest in is in the stock market. And there's been a lot of publicity around the stock market in the last couple of years. And when you invest in the share market, your return primarily comes from dividends and capital gains when the price of the shares that you buy goes up. The primary risk that you carry is capital volatility, because share prices can move up or down, and your wealth moves up and down with it. And this is the primary risk that you carry. Then the third type of asset is real estate. And real estate options, and there are multiple ways you can get access to real estate. Number one, you can buy your own land, you can buy apartments, or you can now, under new legislation, you can always also invest in what we call real estate investment trusts, where again it's a stock market product where many people pool their money together, and this particular pooled investment vehicle goes out and buys a property or something like that, where you have the ability to own an office property, a part of an office property, or a part of a hotel, or part of a hospital, which you wouldn't have otherwise been able to do with the limited amount of money that you have. So again, this is another way that you can get exposure to real estate. And in real estate, you get income through rental income. And then when the value of your land or building goes up, then you get capital gains. So in this model, in this asset, the primary risk that you carry is liquidity. Number one is liquidity, because you can't sell real estate tomorrow. If you needed the money, you won't be able to sell it in a day. So liquidity is a risk. And second is, as I said earlier, while historically land prices have very rarely come down, you still carry the risk that in certain situations where the economy is not doing well or there's a crisis, that land prices could come down. The fourth type of asset is commodities. So commodities, the primary option available in Sri Lanka is gold. You can buy gold. And in the future, the stock exchange is also talking about creating an asset called a gold exchange traded fund, where you can buy a share of gold without actually having to physically keep it in your safe. So the only form of return is capital gain. There is no other return that you get out of commodities, and primary risk is therefore also capital loss. Then you have alternative assets. So these are all buzzwords today. Cryptocurrency is one. Then a lot of people are talking about buying shares in overseas companies. These are restricted. These are restricted at the moment, given the current, currency crisis that Sri Lanka has. But in the past, these have been allowed, and I'm sure in the future these will be allowed as well. So I've included that here. It's harder at the moment to make these kind of investments, but these are also assets which are very big in overseas markets, and you should not ignore it. And return varies across asset classes, but the higher risk is of capital loss, and higher risk of capital loss because these are things that are not well established assets, or not well understood um, types of investment, and so you could also lose money more than some of the well-known asset classes. So these are the main 5 investment assets available in Sri Lanka. That's fixed income, the stock market, real estate, commodities, and alternative assets. So I've just given a few graphs here around what kind of returns each of these assets have given. So if you look at fixed income, since 2004, we were in very high interest rate regimes at the time. So these are kind of treasury bill rates, and now they had come down significantly since COVID. They were in the kind of 3 to 4% range. Now slowly, again, interest rates are going up, but these are the kind of returns that fixed income has given you. The stock market has also had its ups and downs, but if you look at we've had in the last 20 years, we've had 3 rallies, one from 2001 to 2004, where the stock market went up significantly. Then again, post-war from 2009 to 2011, and now since 2020 to today, we've seen a significant surge in the stock market in terms of returns as well. Then land price movements. Again, this is central bank data. You've seen that if you're bought a piece of land in the first half of 2017, you would have made a 50% capital gain on land over the last 4 or 5 years. So this is again quite an interesting statistic. Gold price, as you can see, has gone up from about 200 to about $300 per ounce to now closer to 1,800 ounce per ounce in the past 20 years. So that's the price performance in the last 20 years. So each of these have given pretty decent return if you had invested. Just one more slide on. A lot of people ask me the question: does the stock exchange, Colombo Stock Exchange, does it really work on fundamentals, or is it just speculation? So I would say, as a market, our market works on fundamentals. Individually, the shares in the market, some of those may not, but overall, as a market, we have always worked on fundamentals. And this graph is very interesting graph, because as you can see, the stock market has, so this is what I call a 1-year lag graph between all share index and the GDP. So the all share index always moves 1 year ahead of the GDP. So if the stock market is down, the next 12 months later, our GDP has also come down. When the stock market is up, the GDP 1 year later, our GDP has also gone up. So the stock market is a very good predictor of how the economy is going to perform, how the country is going to be performing 1 year down the line. So as a market, I would say resoundingly, yes, the all share index has always been fundamentally driven as an index, as an overall market. Now within that, there are particular shares which were very speculative in nature and may not move in tandem with fundamentals. But as an overall market, we have always moved in tandem with the market's prediction on how the economy is going to perform in the year ahead. So, having said all of that, this is the last section of my presentation. The question is, how should I invest for 2022? Because this is a question that's on everybody's minds at the moment. I think you're going to see 3 or 4 key themes in Sri Lanka. Number one, you're going to see high inflation. And that's again not only a Sri Lankan thing. Globally, this is going to be the case. We have high inflation. Our real interest rates. What I mean by real interest rates is how much do you get at the bank versus how much is inflation. And this interesting Bloomberg graph published a week ago shows that Sri Lanka has the highest negative real interest rates. That is, at the moment, our inflation rate is 12% or 12.5%. And when you go to the bank, you're getting 6.5%, 7%. So the return that you get on a bank deposit is not sufficient to even cover for inflation. So we have what you call negative real interest rates. And Sri Lanka has the highest amongst all of Asia Pacific. So low interest rates is going to be another theme. The third theme is currency weakness. As you all know, we do have some challenges on our currency, and so we can expect that there may be depreciation of the rupee at some point in the next 12 months. And number four is volatility. I think globally also, central banks are raising interest rates. There are volatility. There is uncertainties around COVID, about Omicron, and perhaps another variant sometime during the year. So you can expect a lot of volatility in the markets in the next 12 months. So then how should you invest? How should we think about investing when you are investing in an environment like this? So my themes for investment in 2022 is number one, the answer is not to keep the cash under your bed. You have to invest, because if you don't invest, inflation is going to tax you. At the current interest inflation rate of 12%, 100 rupees that you have today is only going to be worth 88 rupees at the end of the year. So by keeping money in your under your bed, you're going to lose 12 rupees worth of purchasing power by the end of the year. So you have to invest. That's the only way you will at least retain your purchasing power, is stay invested. Number two, invest in inflation protection assets. Anything that will protect you against inflation. Number one, so basically, land is seen as land, or apartments or REITs, as I said, are seen as good ways to avoid to adjust for inflation, because historically land prices have always adjusted to inflation. And then if you again on top of that, let's say you get, if the land prices then go up by 12% during the next year, you have covered yourself for inflation. Any rent that you may earn from those investments is an additional return that you get. So you can do that by buying land, buying apartments, buying REITs, or there are also some companies listed on the Colombo Stock Exchange with where they have exposure to real estate. You could buy investments like that. Then number three is, as I said, we are going to go into a very high volatile year. So always have access to liquidity. Always have access where for an emergency, if you need to be able to get money, make sure that you have the ability to do so. Because there will be volatility, there may be market crashes, big market surges. So there's going to be a lot of volatility. So make sure that you can sell out, you can get the cash if you ever need it. That will be very important. And in addition to that, our prediction and central bank has verified it today with the raise in interest rates in Sri Lanka as well, is that interest rates will continue to go up during the year. So don't invest for the long term right now, because you will see that in 3 months and in 6 months time, the interest rates that you get at the bank or a finance company is going to be higher than what you get today. So even if you're investing in fixed income, stay short term. Invest for 3 months, invest for 6 months, because at that time you will be able to probably get a better return than what you are getting today. Then the fourth is, because we are expecting some currency weakness, if you think about what are the ways in which you can adjust, because if the rupee depreciates by 10%, so how do you make sure that you retain your purchasing power? One of the options, of course, is gold, because gold prices are determined by international markets. So even if the rupee depreciates, then the gold prices in Sri Lanka will adjust accordingly. So that's one way that you can get access to US dollar exposure without actually physically buying dollars. That's one. And the other is, there are certain shares again listed on the Colombo Stock Exchange of companies who are primarily export based. And so if a rupee depreciates, they get the benefit of it, and that will be reflected in the company's profits and dividends going forward. So these would be my broad kind of four themes and more four thoughts that I want to leave with you in relation to how you should think about investing in 2022. So again, this is my final slide. So the question really is, okay, is this all too much for you to handle? Is this overwhelming for you? I think you don't need to worry about it, because while I said what I said is, as I said at the beginning, define your investment philosophy. Don't think about how much time you have. Then once you define your investment philosophy, then you decide, look, how much of this do I want to manage myself, and how much would I like some professional to do for me. So today there are opportunities available for you in unit trusts or mutual funds, where professional money managers will manage your money for you while you focus on what you are good at. So today they can manage fixed income funds for you, equity funds for you, and real estate funds for you. And you get the benefit of the fact that they are professional, they look at the market on a day-to-day basis, they understand how markets work, and so they are able to make better decisions that you could if you don't have the time. So when thinking about unit trusts, if you are thinking about unit trusts, one is make sure that the funds that you are investing in match your investment philosophy. Number two is talk to your advisor all the time to figure out how much money should I have in real estate, how much money should I have in fixed income, how much money should I have in equity, and make sure that you always assess how well they have performed in the past before you make a decision on who to entrust your money with. So there's a lot that I've spoken about today. What I do hope to leave with you is, you need to have a plan. Number one, don't go in without a plan, but have a plan and make sure that your money is working for you. Know what are the options available for you, and then decide whether you can handle it yourself or whether you want somebody else to manage it for you. All important decisions. And then finally, as you think about 2022, know that we are going into a very volatile year, and make sure that you make your investment decisions accordingly, to make sure that you are covered for any risk, but at the same time earn a very good return. So with that, I'll hand it back to Kavisha to go into the Q&A. Thank you.
Hi, Deshan. Thank you so much for that very detailed presentation. So we do have a few questions from our audience. So the first question is about restriction in investing. Is there any restriction in investing in gold bars, coins in Sri Lanka?
No, you can again access to gold, gold in various form, whether it be pure gold or jewelry of sorts. So to my knowledge, there is no particular restriction. You can have access to it. I believe there are some taxes involved now in buying gold, but those are things that you need to price into your investment decision when you make that decision.
Thank you. Another question, considering the current situation in Sri Lanka, how do you oversee the investment decision in stock market? What is your recommendation to an investor?
Okay. So as I said, we are going to go through a volatile year, and in my view, it's going to be event driven, events both overseas as well as in Sri Lanka. So we are going to have a lot of volatility. So investing in the stock market, you need to be aware. We've seen 2 very good years of very high return. So by virtue of that, you are going to probably see higher volatility this year. But having said that, the big challenge we are going to have this year overall is inflation, and so you need to stay invested in order to make sure that you at least cover for inflation. So I would say stay invested, but watch out for particular events which could create big negative consequences to the market. But stay invested, and as much as possible, expose yourself to companies with US dollar earnings and real estate, because I think these are going to be the 2 big themes, especially in the first half of the year.
Okay, so this question is about the forex trading. Is forex trading on margin permitted, and are there any financial institutions engaging in such activities? And also, there's another question I think you can answer all at once. Is there a possibility to increase interest rates in near future? I think it's sort of a prediction they're asking for.
So the first question, can you do forex trading? The answer is no. At the moment, the central bank has restrictions on buying and selling foreign currency. And to be honest, it's been there for a while. So that option is not legally permissible. I've seen some social media stuff around forex trading, but legally in Sri Lanka, it's not permissible.
Mhm.
Regarding interest rates, yes. So we are going into a year of interest rates going up, not only here in Sri Lanka, but globally. So the US has said, the US Federal Reserve indicated that they would raise rates 3 times this year. So when US raises rates, most countries will follow suit. So today, central bank, in their monetary policy announcement, raised interest rates by 0.5%. And I think interest rates will continue to go up during the course of this year. So you can expect that to be a broad theme for the entirety of the year.
Okay. So earlier you talk about investing or the possibility of investing on gold. So this question again is on gold. How can we invest in gold? It is not traded in Colombo Stock Exchange.
Yeah. So at the moment, gold, the only way you can get access to gold is actually buying physical gold, whether in the form of bars or jewelry. So it's not ideal at the moment, but you basically need to invest in physical gold. But the stock exchange is planning on rolling out gold ETFs or exchange traded funds during the course of this year. And when they do, then you have probably an easier way to get exposure to gold by buying and selling in the stock market. But at the moment, that option is not available. So unfortunately, it comes down to actually owning physical gold.
Okay, thanks. This is on the CSE. What is your suggestion for USD exposed counters in CSE?
I'm not going to give names here, but as I said, look, I think you can speak speak to your advisors, take a look at the annual reports of companies, and look at what percentage of the earnings the company is earned in US dollars, and higher that percentage, of course, the higher the benefit those companies will get when the US dollar depreciates, or the Sri Lanka rupee depreciates. So that would be my guidance, but I would refrain from giving names on this forum.
Okay, thank you, Deshan. This is on cryptocurrency investment. So the audience would like to know more about the investment on cryptocurrency.
Right. So it's a new asset class that's really grown in favor in the last 2-3 years, and Bitcoin, of course, is the most popular, but there are many other cryptos that have come up in the past. So it comes down to the value of money and how accepted these currencies are and will be in the future. At the moment in Sri Lanka, you can again, if you have access to foreign currency, you can trade on cryptocurrency, but there is no cryptocurrency exchange in Sri Lanka, so it's not physically possible to do that sitting in Sri Lanka unless you have access to foreign currency. But it is an interesting asset. A lot of talk about it, a lot of volatility on it, because these prices have gone up and then come down significantly. So it's been traded heavily. In my view, the number one kind of factor to be considered when you think about cryptocurrency in itself, it is a currency, and currency is fiat. So currency is all about the acceptance of these currencies by different people, whether it be other like-minded individuals or by the regulators or the governments. So the value of the currency is really going to be driven by number one, acceptance, and number two, acceptance by the people and acceptance by governments and regulators. So different governments have taken different approaches to crypto. There are some countries which have embraced it and said we are going to start using cryptocurrency, and others are fighting tooth and nail. So if for whatever reason governments get together and decide we're not going to accept it, that's your number one risk. But at the same time, your return will also be if a big country like China or the US or some European countries announce that they are going to embrace it, then suddenly the value of your what you have goes up significantly. So it's kind of a higher risk investment that you are making, but it could potentially pay off in big way, or you could also lose money as well. So you need to be aware of that, the risk return trade off there.
Okay, thanks, Deshan. This other question is on real estate prices. Do you think that there will be a significant drop in the future on the real estate prices, considering the inflation prediction?
Quite the contrary. Historically, land and real estate in general, including apartments and so on and so forth, usually the prices stay in tandem with inflation. So when inflation is high, land prices also generally follow suit. So land and real estate are seen as a good proxy to adjust for inflation. So if you want to beat inflation, kind of stay invested in land and real estate is probably the best advice I can give you. Even more so, I would say apartments even more than land. Apartments are houses because in addition, if anyone has tried building a house in the last 6 to 12 months, would realize that not only land but all the construction materials, whether it be cement or tiles, all of those things have gone up in prices by 40-50%. So again, if you do something now, it's probably going to give you an additional 30-40% benefit, because tomorrow if you wanted to build a house, it's going to be 40% more expensive. So my advice, if you're expecting high inflation, stay invested. I think real estate is probably the best way to beat inflation. Now, having said that, what I do want to reiterate is every asset has risks, and real estate will definitely have its own risks. Not because of inflation, but if there's a global economic catastrophe, then sometimes land prices can come down. So that risk is always there. But if you're asking about inflation, then I would say actually inflation is the reason why you should be investing in assets or real estate, as opposed to why not.
Noted. So this, we can take one last question. This is on investment in .com companies. What kind of safety measures that you could recommend or suggest that we need to take in making investments with .com companies?
Right. Well, if you're talking about technology companies, it really does come down to your assessment of future earnings potential, and whether the company that you're investing in, even if it is making a loss today, whether they have a viable business model to make money in the future. For example, Facebook is a classic example of a company which did make losses in the early years, but they had a model in place where when the time was right, they could make revenue out of this platform that they had built. So the question you really need to ask yourself is, does the company that you are investing or looking at, do they have a model to start making money? And number two is whether you believe that model will be successful. And you can be right, you can be wrong. If you're right, you're a hero. If you're wrong, then you end up losing a lot of money over it. So it is a high risk kind of investment, but at the same time, that is fundamentally what it comes down to. Do you believe that a business model exists, and in the future that business model can make money for you? And number two, whether you believe that is possible.
Thanks. Are you okay to take one more question, one last?
Yeah, that's fine.
This is on REIT, REITs. I know this was introduced last year. We did a couple of sessions as well. Could you explain how it works as an investment platform?
Right. So a REIT essentially has a REIT manager whose responsibility it is to make sure that you buy and sell. They are the ones who make the decisions on what property to buy and how much rent to charge, etc. And what this REIT manager does is they go out and find properties that they would like to buy. And they structure a vehicle called a real estate investment trust. It's essentially a trust where different people can invest in that particular trust. It's a pooling of money, and then this pooled amount of money is then, let's say 1 billion rupees of other, let's say I invest 100 rupees, somebody else invests 100 rupees, Kavisha invests 100 rupees, and everybody invests a certain amount of money, and we get a 1 billion pool. And then the real estate manager, the REIT manager, will then deploy this money to buy an office property or a hotel or a hospital. And then when income is earned from that asset in the form of rent, that rent is passed through to the investors who put the money. So when I put 100 rupees, I will get a return based on the rental that this property gives me. And then in 10 years time or 20 years time or whatever the period, when that land or building is finally sold, I will get also my money back. So that is the concept of a real estate investment trust. But the additional benefit of a real estate investment trust, number one, is that it is regulated, and by regulation, companies have to pay out 95% of what they earn as dividends to the unit holder. If you own a portion of a REIT, you need to get dividends. Number one. Number two is that you will not be you have the ability to access large properties with a small amount of money, which you would not otherwise not have been able to do. And number three is that because these are traded on the stock market, you don't have to wait till that property is sold 20 years later. You can trade it today based on the value of the property, as well as based on demand and supply on the stock market. If you wanted to sell out tomorrow because you have an urgent requirement, you can actually sell your units in the market itself. So this is the structure that a real estate investment trust brings in. So the legislation has been passed, the regulations are in place, and I know that a few market participants are working on actually coming up with some real estate investment trusts in the near future. At the moment, there aren't any that you can invest in, but I am fairly certain during the course of this year that you will have a few opportunities that will come up.
Thanks, Deshan. Thank you so much for answering all those questions, and thank you for all the participants to being so engaging. So Kavisha, over to you.
Yes, I would like to thank the guest speaker today, Mr. Deshan Pushparaja, for sharing very interesting and informative webinar with lots of valuable points and examples. Also, answering for lots of questions of our audience. Hope you all got a good understanding on the importance of investment, understanding the markets, economy and trends, also importance of diversification. Accordingly, we trust all of you will make wise investment decisions in 2022. A big thank you for all of the participants present here on behalf of the Institute of Chartered Accountants of Sri Lanka and on behalf of the CPD committee. Thank you everyone. Stay safe.